Hello, everyone. Welcome to the India panel at Avcj Forum 2020. I have a very excellent panel with me today. Let me start with the introductions. My name is Amit Kadaria. I'm a partner at Morrison Foster's London and Hong Kong offices. My practice is primarily cross-border M&A, private equity, and of course, venture capital transactions, and with a strong focus on India as well. Uh, with this, I'll start introducing my panel. First, we have Kanchan Jain. She is the managing director and head of India Credit at Baring Private Equity. Kanchan, you want to say a few words about yourself?
Sure. Thanks, Amit. Hi, everyone. This is Kanchan Jain. I'm with Baring Private Equity Asia. We are an independent, alternative-focused investment management firm and focused on Asia with nearly 23 plus years in Asia. We have a private equity business, a real estate business, and a credit business that operates in Asia, and I look after the credit business. Um, I think this panel is focused on India. Be looking forward to have a chat and throw some light and discuss some ideas on the credit business. We run a performing mid-market credit business in India. If you've looked at private credit offerings in Asia, they tend to be mostly high octane distressed or special sit strategy, but we look at more direct lending strategies and look forward to chatting some more. Thanks, Amit.
Thanks, Kanchan. We also have Sanjay Kukreja, who's the partner and chief investment officer at Chris Capital. Sanjay?
I am Sanjay, been with Chris Capital pretty much since inception. It's my 20th year with the firm. We are now up to our 8th fund. So really seen the evolution of private equity in India, as we progress through the years. I've, from a track record point of view, we've had 5 fully exited funds behind us, crossed $5 billion in exits out of India. So a lot of questions around the track record and India as a market. I think we feel very proud about what we've done, and it's something that's played out in the industry. So look forward to talking and sharing and going forward with this panel discussion. Back to you, Amit.
Thanks, Sanjay. And that's one of the points we'll discuss on this panel today, which is maturing of Indian private equity and venture capital industry. So welcome. We have Gopal Jain, who's the co-founder and managing partner of Gaja Capital. Gopal?
Thank you, Amit. I work at Gaja Capital. Gaja Capital is a 15-year-old firm focused on India, focused on the Indian mid-market. We've traditionally invested in 3 sectors: education, consumer, and financial services. We've also expanded our focus recently to healthcare and domestic software. We are currently investing from our 4th fund. Our first 2 funds are almost completely exited. We've just completed investing our 3rd fund. Thank you, Amit.
Thank you, Gopal. We also have Mohit Ralhan, who's the managing partner and chief investment officer at TIW Private Equity. Welcome, Mohit, and thanks for giving me company in wearing a suit and tie. So please go ahead.
I'm glad you're wearing as well, I guess. So thanks, Amit. I lead TIW Private Equity with 15 years experience in private equity and 2 decades overall. This is my 5th fund, which I'm running as is, and primarily we are a buyout fund. So essentially we go and buy inefficient companies. There's been a lot that's been spoken about inefficiencies in India. So I think as a fund, we have tried on it. And I guess like Sanjay pointed about exit. So we have given mid-teen dollar returns compounded over, 15 years. And very happy to be part of the panel and share my experience overall, especially in the pandemic and the current situation.
Thank you. Welcome all. It's really good to have all of you here because I see we can provide a diverse set of views related to different sectors, starting with private equity, venture capital, credit, and margins. So really, really do appreciate that. A lot has happened in the last 1 year, as we all know. So I will start with the elephant in the room or the panda in the room, whatever you call it. What has happened during the last 10 months, the impact on the economies of the world. What we saw was a linear progression, the economy is going upwards. We are seeing some sort of recession. And so if I can quote some of the IMF data, the monetary fund, it's basically India is going down 10.3%. The economy is expected to contract at, global economy is contracting at 4.4%. US economy is down 4.3, UK at 9.8, and China is the only sort of outlier with a growth of 1.9%. Uh, how has the coronavirus crisis impacted your world and at a macro level? And also, what do you think is the perception? Uh, how has it impacted India's perception outside of India globally? Um, Kanchan, you want to start that, and I would have each of you give your views on this because it's such an important question. So, Kanchan, would you like to take that?
Sure, Amit. And I think since I'm going first, probably also makes sense just to put some of these numbers in perspective. I know there's been a lot of spotlight around how cases have grown. It's the second largest in terms of number of cases globally. But I think we have to see it in the context of, just the size of the country. And I think very few people, including, us Indians, realize that, you're talking of a 13 or 100 million, size of country. And I don't think a lot of people realize it's 2 times the size of Europe. And that's Europe, including Russia. So I think when we look at these numbers, it's very important to recognize, take the numbers in that context. But outside of that, I think what has been good is the overall recovery rate in India is very high. We're sort of hovering close to 90%. So the active cases represent only 10%. And even after 4 or 5 months of the pandemic, we're still looking at mortality rate of 10 to 12% of what they've been in the worst affected nations. So I think it's important to put that in perspective. In terms of how it's affected, I think my panelists will agree, but economic activity has really picked up, and we are back to about 70 to 90% of pre-COVID levels. I would say across most sectors, barring a few that are at the epicenter of this pandemic. So I think from our perspective, our own experience has been portfolios. If I just talk about our credit portfolio, we invest in senior secured, growth capital investments for companies, and portfolios have held up really well. And I think the primary reason for this, and this it's an important point in the context of private credit globally as well, is that the fundamental leverage on mid-market companies that we invest in is moderate. We're looking at leverage levels of 2.5 to 3.5 times EBITDA, which means there is sufficient cushion and cash flows in this company to absorb the kind of dip that we've seen over the last couple of quarters. So in general, I think portfolios have held up well. And in terms of just sort of opportunities and risks going forward, I think there is a disruption in the financial markets. While there's a lot of liquidity with the banks, credit doesn't always flow to all the sectors that require. So there's opportunities coming out of that. There's opportunities coming just out of sectors, infra adjacent, and sectors in emerging markets which are massively underpenetrated, for whom a pandemic like this is a bit of a blip, and you got to get back to the work at hand. And third, I think there's bigger and better established corporates that have actually become a lot more efficient with significant cost cutting, which means there's opportunities coming out of that. So there's more opportunities from here. There is some uncertainty in the market, but I think there is a huge differentiation underway, and that's probably where managers like us can play a role. So overall, we think there is a good opportunity set arising out of the current situation.
And,
Amit,
and that's something which Gopal and us were discussing prior to this call. Gopal, you mentioned that every coin has two sides, and every challenge gives both opportunities as well as downsides. What's your view on this?
Oh, absolutely. Perspective, first of all, is very important. I've been investing in India since 1990, and every few years there's a crisis. I had just started my career in 91. India decided to almost completely go bankrupt. So I see shades of some crisis or the other in this crisis. There have been a lot of parallels drawn to the GFC, but actually, personally, for me, COVID, given the social disruption, economic disruption, reminds me most about demonetization. The impact on digital and technology, the impact on the financial sector. So when we talk about opportunities, I'd rather start with the portfolio companies. I think the two big gains for portfolio companies out of this, first is going to be permanent gains are going to be cost engineering. See, cost savings are permanent, are temporary. What is permanent is cost re-engineering. So the way good companies have reacted to this is by re-engineering costs, which means that when revenues bounce back, they can be more profitable. And the second set of permanent gains from COVID for existing portfolio companies is innovation, right? Because In some ways, this crisis has given us a view of the future. In terms of opportunity, every crisis ends up creating two or three great vintages for investing, right? We saw that after GFC, to some extent, we saw that after demonetization, we saw that after the dot-com crash, we saw that after the taper tantrum. So this crisis will also create two or three vintages, which will be excellent from an investing perspective. Broadly speaking, opportunities are of two kinds. One is accelerations, the others are displacements. So accelerations are momentum plays. Everybody agrees on accelerations. Digital technology, these are trends that everybody agrees on. And so one set of opportunities are around accelerations. The second set of opportunities are opportunities around which there is lack of consensus. These are around displacements, like the financial sector or the impact on some of the traditional businesses. Let's say in the US, what's the future of Walt Disney, for example? Or in India, what's the future of multiplexes or banks? So two sets of opportunities. We've been active through this crisis. We've invested at both ends of the opportunity spectrum. We've invested in digital and technology. We've invested in contrarian sectors. And of course, time will tell.
Thanks, Gopal. So yeah, that's an excellent point, because we have seen in terms of the work we do as well, focus on these sectors, some of these sectors in terms of investments, both which sort of put forward challenges as well as opportunities. Sanjay, this is, again, your favorite topic. You've been talking about the sort of maturing of Indian private equity space and what you have seen in the last many, many years. How has it been? Like, it's been a bumpy ride, or it's provided a steroid for that sort of growth or maturing you wanted to see?
Yeah, I think there are two separate points there, Amit. I think one is the sort of, the impact of COVID and how that's a, a near-term sort of I think if you just step back, India, has a long-term structural growth story, which, I do think continues to stay intact just because of the underpenetration that we have in various categories, right? And it's always been said that. But I think in India, as time is progressing, we are sort of more and more, living our potential. And so we feel over a longer term perspective, none of that changes. Having said that, there is a significant bump in the road, right? 10% decline in GDP is not something that India has ever faced before. And so how its businesses are going to react, how people are going to do and change their strategies, etc., is going to be very pivotal to that. I think I'm happy to report both from what I see around in the in the general economy as well as from our portfolio companies. Is I'm very very positively surprised as well as delighted to see the response of our companies. They've been very nimble, they've been very alert, whether it's innovation, whether it's cost, rationalizations, whether it's you know uh, figuring out innovative strategies to get back to work and how you manage to go after different market segments, the pivot of business models in certain cases, and use of technology to do that. I think Gopal talked about that. That has been very very pivotal to what's really happened. Give you some context. I mean, as we see this year across our portfolio, we probably get about close to, what was historically maybe a 20-25% revenue growth. This year might end up looking like still a growth. Even though the economy is contracting, we might end up doing closer to 10%. But when you look at the profitability, we'll still see a 25% growth in profitability this year, despite it being COVID. And that's because not all of it is domestic demand driven investments as for us. I mean, that is one clear sector, but there is also exports, there's also IT services, there's also pharma and healthcare. There are always other sectors that have made up for few sectors which maybe have been in the epicenter of the crisis. So just to put that into context, that means basically you haven't skipped a beat if you're still growing profits 25-30% this year. Valuations did come off, that did provide some opportunities, but I think it's been very two-sided. It's been where there's visibility, there's no corrections at all really to talk about, and there have been certain sectors which have had disruptions. And so depending on your strategies and what you're doing, if people have played both sides. We've been pretty active through the crisis, so we've deployed, I would say, $200 million through in the last 6 months. deals in digital as well as in pharma and healthcare, sectors that have been less impacted through, in fact, positively impacted, frankly. So that's just an overall perspective on how things have, played out in COVID. But coming back to the other topic that you really talked about, which is just the maturing of Indian private equity, I've seen that, and it's something I like to talk about because there's a sea of difference, a world of difference between what I see today versus what I saw at pre 2010, right? And if you recall the 2006, 7, 8 vintages of investing, suddenly saw maybe 50 odd investors, GPs, new GPs coming to India. There was a flood of capital, and that muddied waters quite significantly, and subsequent returns were very shabby of that vintage. Post GFC, there was a weeding out. And what remained really of GPs were people who seemed to live through cycles, and that's really come to play. And I think in the last 10 years, decade or so, lots of interesting companies have scaled up. There've been great exits that private equity has seen. Managers have matured up. Competition has narrowed. As well as I would say the entrepreneurs have learned how to deal with private equity. There's hardly today, 10, 20 years ago, every company that you talked about, they were unsure of this whole private equity concept. They hadn't really lived with the private equity investors. Today, most companies that we deal with have had experience of private equity either with us or with other private funds prior to this, and so they broadly understand how governance needs to improve, what kind of diligence requirements that private equity needs, and the need for an exit and a need for an alignment towards an exit, whether it's an IPO, strategic, or what have you. And so I think there is a sea change in those parameters. And finally, even from a talent perspective, the number of CFOs, the number of CEOs, the number of people who've made actually money first time around, second time around, available to do a third turn is dramatically different today than it was, earlier. So I think all those things, the quality of entrepreneurs and the maturing of the market sort of bodes well for the market over the next decade. However, there is having said all of this, we're living and navigating a turbulent COVID environment. And I think, depending on the bets that you take now, your future will be decided from that. So we're really excited about this vintage, and we think it's a very interesting period of investing in India.
Yeah, thanks, Sanjay. I agree with you. You're absolutely right. In the last 10 years, at least from what I've seen, 20 years back, absolutely, it was exactly the way you sort of said. In the last 10 years, we've also seen the sort of maturing of deal terms for India. So instead of just replicating deal terms you would generally see in Europe or US, we have more, India-specific terms as well in terms of investment, because people understand India, Indian market, Indian culture, and then Indian legal landscape. So that streamlined things quite a lot, and that's again a very important indication of the growth and the maturing of Indian private equity. Mohit, you come across this all the time, and then you're at a perfect place in terms of how has the credit market been impacted, and of course your view on the macro.
Sure. So let me start first with the macro. Now, the fact that my colleagues have spoken a lot about the macro, I just want to set the historic context. So while India entered into pandemic, we actually entered on the back of a slowing economy. Now, what's very interesting to see in the last 10 years is the nominal growth of the country has been coming down. So, gone are the days when nominal growth used to be 18, 19% in 2011. Broad money growth, the bank's balance sheet were growing at mid-teens, and hence anything you touched actually grew fairly fast. So growth-driven strategies were here to stay, and companies, were able to grow fairly fast. But in 2019, pre-COVID, the nominal growth came down to roughly 9%. So we actually, if you look at the historic context, unlike 2007, 8 basically, where we entered recession on the back of a bull market. In India, this time we are entering recession on the back of a bear market. So it's an extremely important context to understand. So what we have seen historically that given that we are a buyout fund, the proclivity of an entrepreneur to accept change management in bad market tends to go up. I think that's manifesting fairly well in the kind of rewards companies have shown in last few quarters, like Sanjay pointed out as well in terms of growth. We are seeing something similar. We have seen a 30% compounded in the last 7 months YOY, while the first quarter was fairly bad. But what I really also want to bring out is the mix of the GDP in India. So service sector even last year was growing almost 240% faster than industrial. And in the pandemic environment, work from home strategies have worked fairly well for service sector. So what has happened, while revenues contracted, the cost contracted fairly significantly for companies. So in effect, leading to actually a margin expansion in the last few quarters. So the entrepreneurs have been very nimble to change, and we have seen that manifest, broadly in margins of the companies. Now, in this context, while obviously healthcare, technology, we have done digital marketing companies. We sold one to one of the large conglomerates in India during pandemic. But what's becoming increasingly interesting is some of the other beaten out sectors, and we are seeing massive traction. We did certain deals in real estate, for example, and you'll be surprised that we have delivered 36% compounded in last 5 years in real estate post demonetization. So I think the market is extremely interesting, and there are pockets which are available across sectors. But clearly, we are seeing a distinction away from a pure play growth driven strategy in India to a combination of growth, disruption, and margin. As far as credit is concerned, I think one of the biggest challenges and changes that's happening is that the covenants are changing. So credit's obviously not been very easy, and hence alternative strategies or refinancing has also been difficult. To give an example, lenders have been fairly stringent on allowing redirection or redirecting basically cash flows to shareholders. So there have been restrictions put on that. Now, with all of that, it has increased opportunities for funds like ours to bridge that gap. But an important historic context I want to bring out: the last 10 years have been fairly deflationary, and we believe that the next 10 years will be reasonably inflationary. So in that context, has credit cost really bottomed out is a question to be asked, because this is exactly what happened in 2008 to 10. I mean, when a dollar loan was fairly easy to get, and then there was a massive depreciation from dollar rupee 40 to essentially 55 to 60. So irrespective of lower cost of debt in dollar terms, in rupee terms, it became a nightmare for most organizations. So in that context, it's very important to see the risk of inflation and readjustment on the credit side for corporates. But the opportunity is massive because credit's not easy. Covenants have become difficult, and lenders are becoming far choosier. They have even at times changed the business dynamics, in the sense the basic EBITDA ratios that they were looking at, now they are looking at far more comfort and better security. The credit coverages have gone up. So it's a fantastic opportunity for funds like ours, and I'm sure Kanchan will have a very similar view in terms of opportunities that have been seen on ground.
So Kanchan, that's an excellent segue for you to come in on the credit market. And I know you wanted to talk about a bit of comparison between global and India and the trends you are seeing. So please.
Yeah, I mean, I think, one of the reasons we've had this India credit, we've done this India credit business now for the last 10 odd years. We're on to our third fund. And the reason to look at, India in this way is because we think private credit really offers a great way to defensively access, what's a high growth economy. And I think the fundamental drivers is there's just a tremendous shortage of capital. I mean, whether you look at overall debt over GDP numbers or corporate debt over GDP numbers, we're just fundamentally a much more underleveraged economy compared to, the other economies. But within that, I think the nuance is it's fundamentally a bank lending driven economy. And as such, and within that, about 60% of the lending really comes from state-owned banks, which, tend to be a little bit old school in their approach to credit, are also highly regulated, restricted in terms of their management structures, in terms of government regulations. And I think that's created a significant inefficiency in how credit flows to, to the corporate sector. Specifically within that, when you look at the mid-market in India, we see that at the top level, it contributes 35-40% of corporate output. But by the time you drill it down into a whole lot of sectors, for 75-80% of the sectors, mid-market's actually the dominant driver of corporate output. And you would see contributing 50 to 60% or more of corporate output. Having said that, their access to credit is limited to just vanilla bank lending, which, as I said, has its own sort of shortcomings. I think what it's done is it's created a tremendous opportunity for growth capital to establish corporates, cash flow based lending, but doing it in non-dilutive form, which makes it, highly valuable to a number of these promoters who can see a clear growth path to becoming 2 times over the next 5 to 7 years and would rather dilute, much later. So, for them, for a number of them, having customized growth capital solutions becomes a great way to unlock that growth. Just to give you an example, if you look at non-bank lending in the US, you're probably looking at about 20% of the corporate debt market done by non-banks. I think in India, our estimate is less than 0.5%. That's the sort of scope. So the secular trends that have driven bank lending down, whether it's capital, costs of KYC, risk costs in sort of mid-market lending, you see the same trends in India. You add to that a structural shortage, and you add to that the disruption that's happened in the last sort of 5 or 6 years. Again, give you an example, banks have traditionally provided about 3 trillion rupees year on year of incremental capital to industry. That's about $50 billion. If you look at the numbers in last 5 years, it's close to a third or 20% of that. And this is accumulating shortage now for 5 years. And that's really brought a lot of established corporates into the fray saying, I've got my bank capital for my vanilla needs, but who can I work with as a partner to really tap into more customized capital for growth? So our approach has been to tap into that segment to do performing credit. And the returns are actually very similar to what we typically see out of some of the best performing private equity firms in India. And I think my co-panelists are very much a part of that universe. But essentially, our target is generate sort of high teens returns out of what's effectively, senior and secure debt at operating businesses. So that opportunity has only expanded. It's come of age. The financial market infrastructure is in the right, sort of place, working, helping credit managers. And I think the market's expanded. The disruptions only accelerated that trend.
Thanks, Kanchan. And that's one thing we'll talk about a bit later, the impact on actual deal terms, which is it's a huge area of interest for me, of course, being a corporate lawyer. But Sanjay and Gopal, I would like to come to you now. Again, we heard about the impact of this crisis on the credit market. How has it changed your relationship, the GP-LP relationship metrics? What are the trends you guys are seeing? I think this is of interest to a lot of people who are listening here. So Sanjay, you want to take the lead on that? And
Sure. I don't think there's a significant change with the GPLP relationships. If anything, this gotten stronger over over this period. I think there have been a number of steps we've taken proactively, frankly, through the crisis, just to make sure that people are fully aware of what the situation is. We sort of increase transparency on the numbers. We may not necessarily even go off cycle, for example, from a reporting point of view. So you don't actually wait for the 6 months or 3 months, etc. So we were very open with getting the NAV numbers out there to LPs much prior to when it was scheduled normally. And that was very well appreciated to really walk through that and also just be very transparent and open about what the impact to the underlying businesses are. Many times the NAV impact may not be there because you're going to see the full impact a year later because business is going to take a while to get impacted. We've kind of already prorated that and put that out there and said, look, if it were to play out like this, what would the impact to the NAV be, etc. And then also, how are we navigating through it? And I think LPs really appreciated the fact that, for example, while we were in the middle of the pandemic, we hired McKinsey to really set up a nerve center for all our companies, and that was at our cost. And what we did was, for all of our companies actually then work through that nerve center and say, look, how do I get to work from home? How do I set up? What is business continuity? How do I and when the unlock situation started to come in, how do you get back to work? So that through that entire period, there was a resource, and I think LPs really appreciated that kind of partnership and leadership that we sort of brought to the table to our portfolio, for example. Other than that, I don't see any other significant change. Frankly, people were very supportive. They wanted to come in, deploy more capital, and see if there were more opportunities. But we didn't end up doing any of those deals which needed any of those things because our portfolio, basically did not need incremental capital through this. They managed, very well.
Gopal?
Thanks, Sanjay. Thanks, Amit. So what will be the legacy of of the COVID crisis as far as LP-GP relationships are concerned, right? So let's think. I think one is generic that whenever you come out of a crisis, you tend to go towards known and existing relationships, right? So I think the appetite to experiment with newer relationships you'll see some decline. Sanjay has already covered a couple of things. I think there could be some lasting impact on communication. Uh, you know, we've gone to a 45-day reporting period, you know, through this COVID. So will we go back to 90 days? We've done a call every 45 days with our LPs. So do we go back to 90 days, and when do we go back to 90 days? Maybe there'll be some permanent legacy. Uh, Third is, I think the nature of reporting has changed. Earlier, it was largely about numbers, and you know, we started to give a lot more insight. I think many of us started to give a lot more insight on the operating side. So we have this framework called Survive and Thrive, and Survive and Thrive is basically, you know, the first part is about cost re-engineering. The second part is about innovation. So I think that's going to be a permanent legacy. You know, the heightened operating tone of communication. And finally, the other aspect which was quite visible was the support from LPs to be flexible. You know, we did our first pipe deal in 15 years during the crisis, and we used to always say that we won't do a pipe. You know, we are pure. We were, I don't know for what reason, we were puritanical about this. We would never do a. I had started my career in public markets, but we never did a public market deal at Gaja Capital. We've done our first public market deal in this crisis, and in a crisis, you need flexibility. So, and where do you get the flexibility from? You get flexibility from your LPs. They have to support you to be flexible. Um, so yes, I mean, those are the thoughts on my mind as I think about the legacy of this crisis.
Yeah, and pipe deals have been, again, just going out of India for a second, we have seen those come back in US. We've been doing a lot of those. They come back with a sort of vengeance. So that takes us to the more positive questions, more forward-looking. How do you guys see the recovery happening, or if recovery is the right word here? Any structural, long-term, short-term, or medium-term, the drivers there? I think we covered a bit of those. But do you guys want to talk about that? Mohit, you want to start on that first?
Sure. So I think, few very specific challenges pertaining to India. Obviously, we went through among the most stringent of lockdowns in the history compared to all other countries put together. And the scale, like 1,300 million, is huge. And the impact was massive. But one of the biggest impacts for businesses has been the migration of labor to back to the places they were. And that's been a very serious issue because in spite of lockdown being over, and the pandemic fading in terms of impact on the economic side, the reality is that businesses will have a medium term issue because of migration. And I think that's one of the biggest challenges for manufacturing setups, real estate, and certain other sectors put together. But I think if you look at the fact that the gasoline consumption's actually gone up YOY, and look at the goods and service tax in India, it's at a very reasonable level. All these are direct pointers of a very solid recovery. And I like to point out one important fact that the average Indian age is just 28 years. Superimpose the fact that the death rate for people at large below 40 years is actually 0.1%. And if the average age of a country is just 28 years, in spite of the number of people you see getting infected, the death rate is 10 to 12%, like my panelist pointed out, compared to other countries at large. So I think overall the impact is myopic and the recovery is faster than what we thought. Will this sustain? And are there structural changes in the way businesses are running? Answer is yes. So we are seeing standard sectors like technology and healthcare. Obviously they were very attractive, but the price has gone up, right? Valuations are no longer cheap. And interestingly, if you look at even for stock markets, the valuations are at 35-year high. They're higher than the 2007 peak because, of the printing of money, $4 trillion of money getting into stock markets, and liquidity available at a fairly cheap price. But what we are seeing interestingly is India will do reasonably well in sectors which have intellectual capital usage. Example, R&D and engineering. So manufacturing that has R&D and engineering side, we believe will do extremely well. Example, chemicals. Chemicals as a sector we believe is going to do well. Real estate, we are extremely constructive. These are long-term trends, and the supply has, effective supply has come down, And we have seen very robust demand in last few quarters, and we believe that's again one segment which is going to come back into fashion. And so overall, we believe, given the fact that a lot of time, by the way, comparison to 1918 is done, I just want to bring out two interesting facts. There was nothing called penicillin in 1918, right? A lot of people die because of secondary infection. So antibiotics didn't exist. And second, DNA was not there. So mapping of the virus happened in 15 flat days, right? So those are two things that while when we are depressed, we don't understand those things, but times have changed. And in that context, we believe that the recovery is here to stay. And the nominal growth of India is going to go back to 13 to 14%. That's extremely healthy because for businesses like ours, private equity at large, a 17-18% compounding with 4-5% alpha on the nominal growth is realistically possible over the next few years.
Thanks, Mohit. Kanchan, what is your view of the world on this? And if I were to ask you to pick two sectors which you think will see the growth going forward, what would they be?
I think our approach is very similar to what Sanjay alluded to earlier. We just feel that the structural sort of growth drivers in India are very much intact. Whether it's demographics, whether it's a whole lot of underpenetrated sectors across manufacturing, across infra adjacent sectors or services. And I think there's some which are clearly it's a question of just getting on with it and doing the work. I'll give you an example. We've looked at an oil and gas pipeline laying business, and there's about 15,000 kilometers of pipeline laying that has to happen in India over the next 3 years. And there are all of 7 to 8 players that have the necessary PQ to do it. So these companies are getting tremendous work from the oil and gas PSUs, great gross margins and EBITDA margins, and the only thing, real key ingredient there for growth is capital. So there are, I would say, a number of infra and infra adjacent sectors where we tend to look at businesses with low execution risk. We look at sort of high visibility cash flows to provide growth capital. We look at sectors that have benefited from the reforms that have happened in the last few years. Logistics is one of them. Electronics, which is such a small percentage of a GDP today, with all the changes that have happened, we look at a lot more growth, in those sectors. So I would say, fundamentally underpenetrated sectors where we are seeing a lot of tailwinds, a lot of support from the governments. Again, every one of our portfolio company in our fund has seen strong cash flows in their escrows from their government counterparties, and I think we'll see a lot of that continue going forward as well. So I would pick these as a key sectors where we think there is a tremendous appetite for growth capital. And partly to mention, I think in a lot of our minds, this year has been about protecting our portfolios. There is degrowth. Next year is about which one of these are really going to come back with a bang, and I think that's where the opportunities lie for us.
Yeah, so the key theme basically is what Gopal said earlier: survive and thrive. So it's a good words there, Gopal. And a nice comment on the tailwind as well. Sanjay, one thing I was looking at is the internet penetration in India. I think we are close to 50% now. You see that impacting, and of course, infrastructure and infrastructure in adjacent sectors. You want to talk about any of those?
Is that a question to me or to Sanjay?
Yes, Sanjay.
It was to me, so I'll just take that, and then maybe you can comment separately, Gopal. I see this whole COVID impacting the way, not just in India but globally, how digital businesses are being run, conducted, whether they're new business models or even in traditional businesses, and how they're sort of pivoted towards digital. So that as an investment theme has something that is very strong. I think Gopal talked about doing a deal in that sector recently. We've ended up doing something recently as well, which we wouldn't have done earlier, and that's seen substantial growth. But growth was always available. I think what's interesting is now that with the scale at which they're growing, that they're able to produce very strong economics, which was not the case maybe 2 years or 3 years ago. And so I think finally we're beginning to see good economics coming out of the internet based companies. I think this whole theme will play out further. We've had a very strong round of capital raise that's happened at Jio, which is a very major event in India. And I think from that perspective, the ecosystem of whether it's Google, Amazon, Flipkart, Walmart, whatever, right? All these things coming together is definitely going to spread the digital infrastructure in India, and that'll be good. That'll bode well for these companies, but also a host of other digital companies, as they become, larger companies, and impact traditional businesses as well. Infrastructure, and other things, I think, the way Kanchan through credit side is very different. I think they're playing it from a very different lens. From a private equity lens, it's just been, we found it very hard. Whether it is just regulatory risk, or execution risks and delays and all of that stuff. So we've generally avoided that, and for good reason from our perspective. We just find it very hard to navigate that. I think we want to stay focused on a few sectors where we have a lot of competency. And I think the point that Mohit was making earlier, right, which is the slowing down of nominal GDP is a real factor, right? And so this is, I think you come to India for growth, but I think it's not just growth. It is now growth plus margin, and therefore return on capital. Some of it is already available because you have good entrepreneurs, some great entrepreneurs who understand that. And you can look at that through historically, a lot of businesses where they've generated very, very strong. I mean, if you compare return on capital employed of India relative to any other emerging markets, it's close to double. And that's why the multiples are expensive, because they've proven that over cycles. And so growth then translates into return. And there are businesses like that. You think about IT services, 40+% return on capital, pharma, healthcare, 40+% return on capital, FMCG, consumer goods, again, 40+% return on capital. So if you choose your sectors well, you will end up translating that growth into very solid economic return for investors and LPs. But I think in addition to that, what has changed is this whole COVID environment, basically in a slowing of nominal GDP growth. I think GPs have realized that they need additional levers. It's not just the growth lever, right? So whether it's, working actively, seeking out the inefficiencies in companies and trying to, work proactively to fix them. So to give you a perspective, we actually have a consulting cell within our firm. Full-time consultants we've hired out of McKinsey and other places who actually work on, companies full-time, and run projects for margin improvement and various, even revenue acceleration projects, if you will. So those types of things which have, actively been done historically elsewhere in the world, I think right now, we're kind of leading that, and it's really, paving the way for a second lever, which is margin, enhancement towards return, which also comes from sector expertise that Gopal talked about as well. There's operating experience and all of that you bring to the table. I think the third thing is M&A, and which historically again has been somewhat slower. But I think a lot of the companies are now really picking the using the COVID environment and otherwise as well in the last you see that was a trend that was accelerating in any case prior, and I think with COVID will accelerate even further. So you add these three things, I think those are additional things that will help enhance returns going forward in certain sectors. By and large, we're still going with not really jumping headlong into the contrarian sectors because we feel there's still some more pain there, but going a lot with the with the sectors which have enhanced visibility like pharma, healthcare, IT, specialty chemicals, a whole bunch of other sectors like that, and obviously digital that I talked about earlier.
Thanks, Sanjay. While you talked a bit about the contrarian sectors earlier, what is your view on that?
Those are the difficult ones, right? I mean, after every crisis, the difficult calls are around displacements, because
Exactly.
one of the things that you're hearing in this crisis is this is not the we are headed towards an era where there's going to be a pandemic every 5 years, right? So I think that's a really tough one. But coming back to accelerations, that's the easy topic that everybody can talk about, which is acceleration. So I'm going to talk about accelerations. And so when I think about technology, two things come to my mind. One is Sanjay has spoken about that, which is over the years, there has been a techization of our portfolio. So education's become ed tech, consumers become consumer tech, financial services has become fintech. I think this is just accelerated, right? So we live in a country now where 75% of consumers, individuals have broadband access. It's no longer about internet access, it's about broadband access. And 90% of businesses have broadband access. So technology has become center stage. The second is from an investing perspective, is that, pre-COVID, and it's still during COVID, it's not after COVID yet, but pre-COVID to during COVID, technology pre-COVID used to have a VC-ish feel. And I think something very substantial has happened during COVID. It's acquired a growth capital feel. A large part of it has acquired a growth capital feel because of scale and improvement in unit economics. Uh, I think that's a very substantial and a stay here sort of a change. You will see greater participation from growth buyout investors in technology going forward in India. And finally, in a world where 25% of global debt trades at a sub-zero yield, I think there's a greater premium on growth. So this brings me to the point of India's place in the world, right? I think as one of those few places which is hurt but not devastated, and which has a certain natural level of growth, I think, and a long-term growth, and long-term growth. So there's a certain special place. I think India's importance in the investment world is bound to grow. That's the other thought on my mind.
Thank you, Gopal. I think we are almost out of time now, but I'll still ask my favorite question, which is the impact it had on the real investment deal terms. So we have seen, based on my experience, I've seen more focus on basically tranching of investments when it comes to private equity, more focus on sort of milestones, the governance terms, the exit related rights, at least for, if you have some sort of foreign investor mix into that investment. If I were to ask you guys, what do you think is the top two deal terms each? And very briefly, my apologies, I think we're run out of time. And Kanchan and Mohit, you can talk about what you've seen on the credit side. So you want to start that first, Kanchan? But we are running out of time, so.
Sure, just a quick one. I think, in general, private credit with the competitive intensity in the developed markets have gone more and more covenant-like. And end up looking at sort of unbanked, lower middle market, unsecured debt to these companies. I think in India, it's very different. It's heavily collateralized. It's, very tightly covenanted. And you're looking at, sort of higher mid-market firms and transactions there. So for us, I think it started off always being, sort of very tight on covenants and collateral. And that is only, I think the given disruption is only, tilted the scales in favor of lenders, private lenders, and given us, even better covenants. We've always had permitted indebtedness covenants. We've always had, full ring fencing of cash flows, and that's not gone anywhere. I think it's just given us, better ability to negotiate that across the board, middle market or large.
Perfect. Thank you. Mohit?
Quick one, actually. So, the founders are open to the idea of allowing more operational exposure and intervention, even on the non-equity side, where we are taking a credit exposure. So that's a fundamental change, compared to in the past.
Thanks, Mohit. Yeah, this is something which can, we can have like a separate session on that, actually, on the deal terms, on the private equity and venture capital side. But Sanjay, you have to pick two of your favorite ones there.
I'll say something different. I'll just say that, look, we've used alignment of interest with the promoters, more than the deal terms as our competitive advantage. And I think that's where, historically that served us in very, very good stead. And I don't think, the pandemic has changed that. I mean, yes, you can negotiate slightly better and all of that, but I think the more important thing is to get alignment on exit, alignment on how we're going to build a business. And, with the right set of entrepreneurs, you always get that. So I don't see any major change to that. And I do mean it as a real competitive advantage. I don't see us as a legalistic firm. I see us as a, very relationship-oriented firm that can actually influence entrepreneurs and build that bridge right at the get-go.
Gopal?
Yeah, I mean, I don't think so. I don't think there's any significant change in terms because, if you are building a long-term franchise, I mean, the issue has not been terms, Amit. The issue has been pricing. The issue is that what's surprising is because financial markets have been largely alive right through this entire crisis. I mean, most investors have not been able to relay this crisis to pricing. So I somehow feel that there isn't any significant change in terms, and there hasn't been any significant change in pricing, except when you are dealing with contrarian sectors or you're dealing with, let's say, public market situations.
Sure. Thank you. I think with this, we are out of our time on this, but I really do appreciate each of you joining us and for people listening into us. Thank you. Have a nice day and hope we
You.
recover fast from this.
You've done a great job, Amit. Thank you.
Thank you. Thanks, everyone.
Thank
Thank
you.
you.
Thank
Thanks.
you, Amit.
Thank you,
Thank you,
everybody.
guys.